Good morning and welcome to the IML webinar today. My name is Wayne McGawley, Head of Retail here at IML, and I'm joined with Daniel Moore. Daniel Moore's Portfolio Manager with IML. And today's topic is interesting and quite pertinent. The topic of today's webinar is opportunities and risks in today's share market, and today's discussion will be exactly on that and the extremes of those two, so the extremes of the opportunities that are there for investors today and the extremes on the risks. In terms of today's webinar, there'll be Q&A between Daniel and I, and we welcome questions from our clients, so please submit those online and we'll get to those questions. If we have more questions than time, then our IML state managers will be back to you to answer any unanswered questions. So thank you today and welcome, and I trust everyone's well in these really challenging times. Thank you for joining us, Daniel. It's good to see you. We're both from home, normally in the office in Sydney together, but we're both from home. Daniel, let's start by having a look at the last financial year, and if you could just perhaps provide some sort of context on the kind of world that we lived through for financial year 21.
Thanks, Wayne. I guess we've all heard the word unprecedented many times, I guess, over the past sort of 12 months plus, and it really was. FY21 was an incredible year. We all started it, I guess, in some form of lockdown, no matter where we were in the world. And governments and central banks responded in an astonishing way, really. We saw quantitative easing in a matter of weeks. We saw quantitative easing actually be greater than what was put in place during the entire GFC. So we saw more money printing in the matter of about 4 weeks than we did across all the GFC. In the US, I think it was around 26% of GDP. It was a massive number. And then we saw governments as well put in enormous fiscal stimulus plans around the world. I think the average is roughly about 10% of GDP, but some countries like the US and Australia, the fiscal stimulus was closer to 20% of GDP. So just massive numbers, and this really led on to a real risk-on marketplace, and we saw a situation where the more risk you took, the better the return, and we saw astonishing rises in speculative assets or cyclical assets, commodity assets, and at the end of the day, the financial year, the market was up 28%, which I would say many people would not have predicted at the beginning of the financial year.
And Daniel, just breaking down that 28%, what were the key drivers of the ASX for financial year 21?
Look, as I said, really the more cyclical sectors definitely drove the market. So we saw the iron ore names in Australia do very well. They're up considerably, which makes sense because I guess the iron ore price has went up to all-time highs, above $200 a tonne. And we also saw banks have a massive rally off their COVID lows to a situation now where the banks, up until a few days ago, we were trading, nearly all of them, I think, were above their pre-COVID highs, which is despite raising a lot of diluted capital at the bottom of the market. So we've seen a huge re-rating in the resource names and the banks, and that made up a bit over half of that total return for the market. So that they were a huge driver. And then we saw a recovery from most industrial companies, but just not quite to the same extent as those sort of iron ore companies or banks. And obviously technology and discretionary retail, strong sectors as well.
And Daniel, taking a more current view, how are you seeing things as of today?
Well, I guess really the title of the webinar gives you a bit of a hint. It's a market of absolute extremes we're seeing right now, and there's real opportunities, but there are substantial risks as well. And we've really seen this enormous boost of liquidity into financial markets around the world has created this real risk-on environment, which has meant investors' risk appetite up until a few days ago has just been so strong. And this has led to investors seeking capital gains and really buying those more cyclical companies, the commodity stocks, the more speculative companies, and driven those share prices to valuations which look really extreme to us. Even if we look at the iron ore names, while the valuation multiples on spot commodity prices don't look particularly high, they're essentially close to capitalizing all-time record prices, well into the future. That scenario really leads to significant risk because all these companies now have inbuilt very high expectations for the future, for growth or commodity prices, and any disruption, any disappointment, I guess, to those inbuilt expectations, is a real potential risk for capital loss for investors. And when you only sort of have to go back to the last cycle with iron ore, for example, the iron ore price the last peak, I think, was back in February 2011. And when the iron ore price peaked in 2011, the prospective returns of BHP and Rio over the next 5 years was around -40, -50%. So when you're investing in these companies, when the commodity prices are all-time highs, while the cash flows are great today, the outlook for the share prices, the prospective returns from those share prices, looks very risky to us. The flip side of this are the lower risk companies, the quality industrials in the market, because there's just been such this strong risk appetite for capital gain. There's been a complete lack of interest, I guess, in companies which have more recurring, predictable earning streams. Normally, these sorts of companies trade at sort of premium valuation because they offer that downside protection or degree of certainty and predictable dividends. Funnily enough, despite rates being zero, these companies have really just not participated. And the prospective returns from these companies is literally the complete opposite. It's at the absolute other extreme. It looks very favorable. The valuations of these quality industrials, I'm talking the Amcors, the Brambles, the Telstras, the AusNets, looks fantastic, and they're low risk. I think the future is still highly unpredictable at the moment. There's still a number of risks out there, and I think a few of those have been highlighted in the past few days. But we're really comfortable where we are right now with the portfolio, because there's still a lot of risk out there, and those sort of lower risk industrial companies, you're getting very well rewarded for taking that sort of low level of risk, which means hopefully the prospective returns are favourable.
I mean, to that point, Daniel, I mean, IML's been through several cycles, and I can't recall a time where IML's portfolio, from a relative value point of view, has traded at such a discount to the broader market.
Yeah, I think if we look at valuations in an absolute sense, they're pretty attractive. I think we've seen them more favourable, maybe around the European crisis. But from a relative value point of view, compared to the opportunity set, the valuation gap is just at absolute extremes, and it's just that risk appetite is at that extreme, and you can look at many indicators of risk appetite in the market. Retail participation's a big one, and retail participation in the market is within a hair's breadth of the highs we saw in 2000. And we've seen a number of speculative assets, Bitcoin, etc. And I read the other day, with astonishment, a CIO of a very prominent super fund said, now's not the time for capital preservation. Now's the time to be, taking on as much risk as possible, essentially, which I thought was an incredible statement, given we've just had a 50% rally off the lows and are hitting all-time highs right now. So that this relative valuation gap is just because of the extremes we're seeing in the market at the moment.
Daniel, let's drill down. Let's talk about the portfolio positioning. If you could share with our audience, please, how the portfolio has been positioned.
Yeah, look, I think you can probably describe our portfolio in two buckets. We've got a big collection of quality industrials, I guess, that are all leaders in their industry, that have really done a good job through, their businesses have performed really well through COVID, have very strong earnings and cash flows. Most of these businesses have actually grown their earnings all the way through COVID. Companies like Amcor, Brambles, AusNet, etc., but not Steadfast as well. But their share prices in general, for most of them, is actually 10% plus below where they were pre-COVID, despite the higher earnings, despite the better balance sheet. And in most cases, these businesses have actually improved their competitive position through COVID. They've structurally reduced their costs or invested in their business in a way which improves their long-term outlook. But despite that, the share prices are either flat or down from where they were pre-COVID, which is quite odd for us. I mean, a good example is Amcor, where its share price is down around 10% pre-COVID, and it's actually flat over 5 years, Amcor, and they've improved their earnings, their EPS, 30% over the past 5 years. And they're really starting to develop a real competitive advantage in sustainable packaging, which is just a huge growth area in the market. By 2025, they will have all their packaging solutions will be recyclable or reusable. They're investing $100 million per annum in R&D, which is light years ahead of any competitor in the world. But their share price is actually down, which is just a bizarre situation. The other group of companies we've invested in is a selection of companies which have had their earnings been hurt through COVID, but their business models are well intact, and we think those businesses will recover quite quickly as the COVID lockdowns eventually fall away. And maybe that's 12 months or 18 months, but at the end of the day, they're strong businesses and will recover quite well. And we're talking about stocks like IAG and Orica, United Malt, and some of these stocks are down 40% from where they were pre-COVID. But they're making, all these businesses are making good money. They're not like airlines that are losing money and having to raise capital. They're making good money, and they will come out of COVID stronger companies. But their share prices are very weak, and we think the return outlook from here looks very favorable.
Daniel, just talk about this notion of margin for safety. Obviously, Benjamin Graham coined it many, many years ago, but how does that sort of fall into your thinking and portfolio construction, stock selection?
Yeah, I mean, we sort of discussed it a little bit in that a margin of safety is really, you invest in a business because you think it's a good business that's going to grow its earnings over time, and you have a valuation for that business. We then try to buy these good businesses that can grow their earnings over time at a discount to that intrinsic value. We do that because obviously we want the best return we can possibly get, but the other reason is the future is very unpredictable and it's great to have a bit of a cushion, I guess, if things don't play out the way you see. So that's, whenever we buy an investment, we have a real strong eye to the downside of the business itself or the market, to try and protect our investors' capital in case things go wrong. And I think it's just a really important concept right now to remind ourselves of when times are strong like at the moment, and risk appetite's so high and people are just chasing share prices that are just going up and up and up in the more speculative places. You just got to be really careful not to extrapolate great conditions into perpetuity. Whether it's the iron ore price, you've got to be very careful not to assume a $200 a ton iron ore price very long. Whether it's a new tech company, a new startup tech company, you need to not just assume the margins these companies have will be in perpetuity. You have to consider new competitors entering that space. And if we look at buy now, payday later stocks, I mean, it's no surprise to us at all that we've seen new entrants enter that marketplace. And the share prices, the valuations, we're just implicitly assuming such huge market shares globally and margins to stay relatively stable. Just seemed a very aggressive assumption, and now we're seeing PayPal and Apple enter that space, so we've seen some weakness in those companies. So the point is that there's a lot of companies at the moment where that margin of safety is not there, and to us that this environment is still, there's just so many potential risks out there, whether it's COVID mutations, or whether it's cycling of stimulus, or the removal of QE, inflation. There's just a number of things out there which make us cautious. And then I guess when you've got a market that's in such a risk-on mode, that makes us even more cautious to make sure whatever we invest in makes complete sense and has that margin of safety.
And related to that, of course, Daniel, is a strength of balance sheets. It's worth commenting on what we're seeing as far as a balance sheet strength in the companies we own.
Yeah, I mean, look, most of the companies we own have phenomenal balance sheets, but to be honest, the market in general, many companies have great balance sheets at the moment. I'd say that coming out of COVID, the companies that had good balance sheets going into COVID and have performed well, their balance sheets are in great shape, as they were pre. The companies that had bad balance sheets going into COVID, a lot of them have raised capital. So the balance sheets of many companies, not just our portfolio, but many companies, is very strong. Some of our companies have the best balance sheets they've ever had. Sonic Healthcare is a great example where obviously through all the COVID testing, their earnings have gone up to extreme levels now. I think that their cash flow per annum is $2 billion, which is double what we thought it would be a year ago. So they've almost got no net debt, which they've never had in the history of the company. The company's been around, I think, almost 30 years. So there's a lot of companies in our portfolio, whether it's the supermarket operators, or Sonic Healthcare, or Steadfast, that have fantastic balance sheets, and it does give them optionality into the future for potential capital management, which we're seeing many of our companies perform, and other companies as well, whether it's off-market buybacks like Telstra, or potentially acquisitions as well. But we just got to make sure the companies we own are disciplined with that money, because asset prices are generally really high at the moment. The flip side of the good balance sheets is we're also seeing potential corporate activity. Well, we are seeing corporate activity in a number of companies we own, because the balance sheets are so strong, and that strong balance sheet sometimes is not reflected in the share price. So we've had a number of companies in the portfolio have takeover bids, which is pleasing, and we see a number of our holdings are definitely candidates given where the valuations are at the moment.
Yeah, we'll come back to corporate activity because we've got a question on that. But sticking to the portfolio, Daniel, do you want to comment on a couple of key stocks that you hold and the investment rationale?
Look, I think the two of the bigger opportunities we see are really operating in plain sight. IAG just looks exceptional value to us at the moment. It's the general insurer that owns brands like NRMA. They operate home insurance and motor insurance, which is the bulk of their earnings, and they're just great franchise, great brands, huge market shares, and they have a real strong competitive advantage in being able to serve those customers in a cost-effective way. Where the business got caught out during COVID, by the way, this stock's down 40%, over 40% actually from its pre-COVID levels. Where this company's got caught out is in COVID, they have commercial insurance for small to medium businesses around business interruption. And during COVID, they had to make a big provision for potential claims around business interruption. The claim the provision they made for the claims was well over $1 billion. It's an enormous provision, much like the banks made with with mortgage, potential bad debts around mortgages and bad debts around small businesses as well. They raised 900 million of capital as well because to fund those potential claims. And this was in the middle of COVID. What's happened though is today, those claims really haven't come through in any meaningful way. And when we look globally, business interruption claims we've seen, even in countries that have been hit really badly, like the UK, have been much smaller than anticipated. So we see IAG as a company that's made these enormous provisions, has a balance sheet full of excess capital, but the share price is not far off its lows. It's a real bizarre one because the banks, the Aussie banks are almost in a very similar scenario, yet their share prices have recovered back to pre-COVID levels or above as they've written back those bad debts. IAG is yet to write those provisions back, but we would expect they will over the next probably 6 months. And then if we go back to the core business of personal lines insurance, home and motor, the outlook for that is really strong. I mean, we're seeing really good volume growth in that market, and we're seeing a really disciplined insurance market where premiums are going up. So the outlook for margins is favourable as well. And then the other one is Orica, which is a global, the largest global explosives operator. Again, share price is down roughly 40%. Earnings have been hurt through COVID. Earnings are roughly down about 40%. But they're making, as I said, they're making good money. They haven't had to raise any capital at all. And they've been hurt because of just general disruption to mining, closures of mines, etc. But what we do know, obviously, is commodity prices are at record highs around the world. And once those restrictions are lifted, mining volumes will absolutely return to where they were because it's so profitable for the miners to operate at the moment. So we think the company earnings will recover, relatively quickly once those restrictions, are lifted, and we are seeing a gradual improvement. We expect that improvement to play out over the next 12 to 18 months, and the business continues to invest in itself, invest in new product innovation. So we think the outlook is good over the next 5 to 10 years as well.
Daniel, got a question in relation to the portfolio positioning of those preference and non-bank industrials. And the question is IML sort of cognizant of the risk of those non-bank industrials being disrupted?
Yeah, no, that's a very fair question. when we look to invest in a company, we're looking for a company with a strong competitive advantage. We really like companies that are number one in their industry. However, there's no guarantee a company will remain the number one in an industry, and so what we're additionally looking for is companies that will be number one in the industry in 10 years' time. So we're looking for companies that are continuously investing in their business, and looking, particularly we're looking for companies that can actually grow that competitive moat over time. So not just stagnate, but try to improve the competitive position of the business, try to improve its cost position relative to its industry, out-invest their competitors in new product development, ensure that their IT is cutting edge for the industry, all those things. So we're not just investing in quality industrials that are the current leaders. We're investing in the industrial companies which we think will be the leaders in 10 years' time. So that's companies like Amcor, that's investing way ahead of their competitors in sustainable packaging. That's Brambles, who's investing in their technology to improve the loss rates of their pallets through wireless technology. Companies like Orica, who's investing in wireless blasting, which we think will revolutionise the automation of mining in the future. Companies like AusNet, that's investing to upgrade the electricity grid for renewables, all these sorts of companies. So when we're investing, it's not just a static view of the conditions today, we're really looking.
Daniel, the inevitable question on inflation and the impact on IML's portfolios.
Yeah, inflation is a really hot debate at the moment, whether it's transitory or not. We don't have a particularly strong view either way, but we definitely want a portfolio that can weather the impacts of inflation if it does arise in a more permanent way. The two issues with inflation is one, higher interest rates, which really weighs as an anchor, or is gravity, I guess, for high PE stocks, growth stocks, technology stocks in particular, where the value of those companies is far off into the future. Higher rates will definitely have a very negative impact on those companies, and we really have very low exposure to those sorts of businesses. So we'll be well insulated from that. The other thing is inflation creates rising costs for businesses, and it's really important you invest in businesses that have a degree of pricing power to pass that on to their customers, which we certainly do across the portfolio, because if you don't have that pricing power, margins are going to come under a lot of pressure in a rising inflation environment. So we think we're very well positioned if that does eventuate, but generally rising inflation is not fantastic for equity.
Daniel, with the cash rate basically at zero, what's the projected yield, or what kind of dividends can people expect on the IML portfolio?
Look, pretty resonant to give a forecast, but surprisingly, given rates are zero, the dividend outlook for our companies, the yield outlook is really strong. Many of the companies own are paying yields of 4%, 5%, 6%, which, if you told me that would be the case when rates are zero, you would knock me down with a feather. But so the yield outlook for the funds is really strong, particularly when you combine the strong balance sheets. So we're expecting pretty high payout ratios. Businesses, a lot of businesses we own have excess franking credits as well. So the outlook's really good, much better than I would have thought, to be honest. We're pretty optimistic about the dividends for the fund. It just puts us in a really good place, because if you think about the very long term, 28% a year is not normal. The very long term is around 9% or 10%. And if you can earn 4%, 5%, 6% from dividends, which tend to be the much lower risk part of your return, you're almost halfway there. You're getting a good return for the year. So no, that's definitely something we feel pretty good about in regards to the portfolio and the outlook.
Daniel, got a question on our view on Horizon.
Yes. No, Horizon is a company we own in the portfolio. It's a company we really like, and it's really really cheap, incredibly cheap at the moment. That stock's yielding, I think, close to 7% fully franked. Has a fantastic balance sheet. They own the monopoly rail network in Queensland, which transports predominantly metallurgical coal used for steel. That's about 60% of their earnings, or 60% of the valuation, where they earn a regulated return. And they have very high quality customers, and they earn that return no matter what the volumes are on that network. So it's an incredibly stable earning stream, which we expect to last 30 years plus. That's 60% of the business. The other 40% of the business is the wagons that go on that rail, which they rent out essentially to the miners, and they're on very long-term contracts, 7 to 10-year contracts with inflation clauses, high-quality miners. That business is roughly 50% met coal, sorry, 40% met coal, 40% thermal coal, and 20% bulk. Bulk is anything from grain to lithium, iron ore, or all other things. The thermal coal business is really where I think the stock's got a bit of a ESG black mark and why it trades at such a low valuation. The good news is the bulk business is growing at a rapid rate. And what Horizon is going to do is essentially over time, when thermal coal eventually volumes start to fall in that business, they're going to use those wagons and reallocate them to the bulk business, where they continue to grow market share. And they will be able to grow market share in the future because they'll have this real big cost advantage over their competitors who will have to buy new wagons to win new contracts, where Horizon will have these existing wagons they can use. So the company's at a real extreme low valuation, a fantastic yield, strong balance sheet, one of the best management boards we've come across. And we see this really good growth angle in bulk, which really can offset some of the declines we see in thermal coal in the future. So it's a really good, stable earning stream, fantastic cash flow, trading at a real big discount. Excuse me.
Bless you. Bless you, Daniel. Into the time, one last question, a relevant question. You have touched on it, but corporate activity. We've seen some. Is it likely to continue, and what does it mean for IML portfolios potentially?
Yes, I think there's a lot of money around. It's really hot at the moment. We're getting a bid every couple of weeks. I don't know how long it's going to last for, but given there's a lot of companies with very strong balance sheets out there, private equity-like businesses which have really strong cash flows and low debt, and obviously are priced reasonably. And we certainly own a lot of those sorts of companies, and that's why we've had a number of bids, whether it's Tabcorp, Vital Harvest, Link, Spark Infrastructure. We got a bid the other day. Sydney Airport the other day. Like, there's just so many. Look, we definitely think there's a number of stocks in the portfolio that are massive candidates. API is another one we had. So we'll see, I guess. These things, these M&A booms don't tend to last forever. They tend to last a year or two, and normally precede a couple of times in the share market going forward. I remember the last big M&A boom was in 2006. So we'll see how long it goes for, but yeah, we wouldn't be surprised if we've got a few more bids, that's for sure.
Daniel, thank you for your time and update for our clients today. And again, everyone online, thank you. I think the key message today for our listeners is just really highlighting that the contrast of the environment we're in today, the opportunities contrast with the extreme risks. You know, I think it's important to note IML has been through these periods before, 20 odd years of experience through many cycles. It's important for our investors that we stay disciplined, we stay true to what we've conveyed to you in the way in which we manage your clients' money, which we try to do prudently, responsibly, with a long-term, approach in mind of wealth creation. It's been a market whereby risk has been rewarded, momentum has ruled, and the truth is that won't always be the way. And whilst IML portfolios have lagged of late, the real message for you guys going forward is where IML sit today, sitting at big discounts to relative value. We think the prospective returns look quite solid from a capital growth point of view and underpinned by those important dividends, which are not often spoken about in times of exuberance. So thank you all for your time. Thank you, Daniel. We'll send through CPD points. If you have any questions beyond what we've covered today, please reach out to your IML representative. Thank you for your time and support of IML, and wish you all the best in this uncertain time. Thank you.